couple of the more unique guys in our industry are two brothers, Eric and David Coffin. They have a publication called The Hard Rock Analyst. Very unique, very individualistic. They have an interesting approach to their newsletter. Gentleman I'm speaking with right now, Eric Coffin, is the business guy, for lack of better terms, and his brother David, who's going to be joining us in a minute, is the technical guy from a geological standpoint. But you know, between the two of them, I have to say that you guys probably are certainly close to being the most respected newsletter writers in our business. Am I correct? Of course I'm correct. You bet.
Well, thanks, Al. Yeah.
No problem.
Sure. I'll go along with that.
You'll go along with that. Tell us a little bit about the Hard Rock Analyst.
Dave and I started it 15 years ago. Prior to that, we had owned basically a consulting business together. That was consulting business in the mining sector. We essentially did exploration consulting. And we started looking at companies and doing some investing on our own, and the way that we sort of analyze companies, we'd send things around occasionally, and people that we sent it to started asking for more and more of it, and we said, you know, it was about the same time the internet sort of got going, and we said, you know, maybe we should give this a shot, and we started doing the newsletter, and it was basically 95 at the start of a short, sharp bull run. So we ended up looking smart really quick before we looked dumb for a while. And, but we stuck around partially because, and it was because we came out of the industry as opposed to out of, say, the brokerage business or promotion business. Our view was once things turned around, and it took a while, and it was we went through a fairly ugly cycle there. Because of that, because of problems in the sector, we felt that when things did turn, it was going to be a very big cycle. It was going to be a secular bull market, which is something commodities, metals haven't seen for 40 or 50 years. And indeed, that's what we've got, and we're happy to have it, and we just basically spend our time looking at companies individually on individual merit, and we basically look for companies where we think they've got the projects and the management and the market talent to be able to grow their asset base rapidly and to get the market to appreciate and pay up for the fact that they're doing that.
I don't think there's any question whatsoever that we're in a secular bull market right now. It's, you know, Jim Rogers has been on that bandwagon for quite some time now. The former co-founder of the Rogers Raw Material Fund, Clyde Harrison, is very much on that particular bandwagon right now, as I am also. I think that with the growth, pardon me, with the growth that's coming out of the Far East and the growth that will, I think, re-energize itself, certainly in the United States, commodities, in my opinion, are really the safest place to be right now.
I think they are, and it's not to say there's any sector in the market that's not going to have its ups and downs. Commodities, like companies, I think you have to look at individually. But even, I mean, if you take a look at how deep and how nasty the recession that we're coming out of was, and if you take a look at the price curves for most metals, for instance, through that very ugly downturn, the falls were actually much less and much more quick in percentage terms and in terms of time frame than a previous deeper recession. And to us, that just reiterated the message that, you know, this isn't your father's commodity market where it's up and down every 3 years. This is a secular market, and you're seeing growth in the areas of the world that are really the metal users. I mean, Dave and I have been pounding home for years now. You know, yes, obviously you got to worry about what's going on in the States. You got to worry about some of this stuff going on in Euroland. But if you sit there and get fixated on Washington and say, I've got to see what's going on in Washington or what's going on Wall Street today, that's going to tell me what metals are going to do. That's not going to tell you what metals are going to do, because that's not where the users are.
Not even close. You know, an interesting question that I would have for you, and I guess something I'd like to bring to the attention of folks watching this, is we were in a very deep recession. There's no question about it. Probably the scariest economic times that I've ever seen in my lifetime, and I've been around for a couple of years. And there are people today who would say, well, we're not coming out of it yet. And I would be one of the people who would definitely be in that camp. I'm not sure that we're coming out of it yet. I think there are a number of issues out there that still remains to be seen how they're going to turn out. But, you know, some interesting things that have happened lately are the unemployment numbers, sorry, that came out the last week of March, specifically on the 31st, if I'm not mistaken. The ADP numbers and then the government numbers that came out on April 1st show an improvement of sorts. General Motors, interestingly enough, on April Fool's Day, and I hope this wasn't a joke, announced that their sales were up 47% for the brands that they retained. I mean, that kind of tells me that, well, my gosh, maybe things are working.
I think things are working. I mean, what we just went through was it was a debt crisis. This is the sort of, unfortunately, it's the kind of recession, if you want to even call it that. It's almost worse than one that comes along every few decades. It's debt driven. Those sorts of recessions, it takes a very long time to get out of. We're definitely not out of it yet. We won't be out of it for a long time, but some of the data points, because of the focus we have on what we call the growth economies, the Asia and India and places like that. Like one of the most interesting statistic I actually saw this week was probably one most people didn't even notice, and it was a story out of Singapore. And basically what the story said, there's been a lot of complaints in Singapore and in South Korea because of the waiting times for container shippers have suddenly gotten fairly long. I know a year ago, guys that were looking at things like the Baltic Dry Index, and that index basically follows pricing for bulk shipment type Cape-size vessels, basically ones for iron ore, coal, stuff like that. That thing fell out of bed, and everybody went, okay, that's it, it's over. I was very interested to see these guys complaining about shipping costs going up and shipping times lengthening, because these are guys shipping containers to the U.S. In other words, not guys shipping wheat to China or oil coming out of the Middle East. This is guys shipping containers to the U.S. What's in those containers, I don't know. I assume it's the usual Walmart stuff. But that's not to say everything's great, but obviously somebody's buying something somewhere if these guys suddenly have shipping issues.
I don't think there's any question about it. Somebody is buying something somewhere, and hopefully we're on our way out of this. I think we're in the woods for a while, though. But the one thing that I would agree with you wholeheartedly is we are definitely, I think, in the throes of a major, major secular bull market in commodities. We're going to drag David Coffin in here now, Eric's brother. We're going to talk a little bit about specifically what investors need to look at if they are considering actually investing in this sector. Hey, Eric, always a pleasure, buddy.
Nice to see you, Ganel.
Nice to see you.